All right, good evening, everyone, and welcome to tonight's webinar, Boosting Trades with Price Action and Fundamentals. Now, before we get to the actual webinar, please take a moment to read the risk disclaimer. It should be long enough. All right, so what are we going to discuss today? Well, firstly, I'll introduce myself, obviously, for those that don't know me, so you have a little bit of an idea of who I am, what I do, and why I'm talking tonight. Furthermore, we'll look at different sections when it comes to both aspects of what we're discussing tonight. We'll look at the stages of the trade so you can fill a little bit in the blanks of where exactly we are. And then we'll look into price action first, deviated in different sections. And then we'll look at news announcements as well, how to use the news announcements afterwards. And obviously we will be going to charts. And at the end, before the Q&A, I'll wrap it all together and see if I can find a good example for you guys to get an idea of how you combine all of that. Now, for those that are on YouTube, the last part won't be there for you. The Q&A will be exclusive to the webinar. So if you want to join us for a Q&A, please join us on the webinars as well. All right, so let's get started. So first of all, about me. Well, my name is Mike Rotink. I have traded in Forex for a little over 15 years. It all started when I was studying international business studies, an IBS program from Cambridge in Delft College in the Netherlands. It was a joint thing. And, I was looking for a hobby, but, you don't have much time. You're studying, you're doing programs. So I rolled into what is now known as Forex. It was a little bit different back then. And like most of the people that roll into Forex, especially at that age, it was with a completely wrong mindset of, hey, I just want to make some extra money. You know what? Maybe this can be my income. Yeah, about 2 accounts down the line and 6,000 somewhat YouTube videos of self-proclaimed gurus, it became obviously clear that that's not the way it actually works. So I ran into that wall myself a few times, young and stupid, want to do way too much, way too fast. So what ended up happening is I basically threw everything in the bin that I thought I knew and started reading up on basically the technical basis on which everything is founded, how it was built up, and et cetera, and really start learning every little laying brick along the way. All right, so that slowly progressed into my account becoming profitable. Then I started climbing back, recovered whatever I lost beforehand, and then you fast forward that 15 years, I consistently created a system that no matter the market situation, I ended up with a consistently profitable account at the end of the year. And that made me achieve my goal that I set out initially to do once I started getting an understanding of it, and brought me to what do I do. So once I rotated out of this a little bit, I started doing the webinars for the last 6 years now. And this ties in with the mentoring. Basically, what I wanted to do is, like I said, I ran into this wall as well. Okay, so how can I pass on some of the knowledge that worked for me in my way to hopefully pass it on to others to try and help that it might work for you too. So this is what these webinars do, and that's also with the mentoring, where I just look basically, okay, what do you do? How do you do it? And how can we make that fit in what I know works, at least has worked for me, and then with what you're already doing, right? So that's kind of the thing. And other than that, obviously, Rotadell, I do other projects as well. I mean, work freelance with startup companies, but that's more in the marketing and sales departments, branding strategies and stuff like that. I mean, I did study international business after all, but I tend to also get pulled in for financial things like investments and stuff like that to advise on companies when they're looking for an investor or looking for investment, and with startup companies. Right, so that's me in a nutshell, and let's get to the stuff you actually got here for. Right, so when we look at the stages of a trade, right, we got before the trade, we have during the trade, I didn't mention here, and we have after the trade. Now, the reason that during is not there is I'll explain in a minute. Now, before the trade is basically where we do all the technical analysis, where we plot out our trades, where we find our entries and exit points, And by doing the technical analysis, you find your entry and exit points, which allows you to plot your trade, right? Duration, micromanagement along the way, and that ties in with fundamentals, predicting how fundamentals are going to tie into your trade, regardless of what view you're using. So whether you're trading on 15 minutes, shouldn't be doing, but an hour, 4 hours a day, or maybe you're a week or months trader, right? It depends on what you're doing. But in any case, no matter what you do, this stage is set. Now, everybody approaches this differently. I have my way. And if you put 10 other traders that have 15 plus years experience, we'll have a disagreement with each other how to do it because we find a way that works for us. So there are a few hard lines though, and we're going to discuss those a little bit later today. Now, during the trade, this is where the micromanagement of your trades work. Now, this is where it gets a little bit more nuanced, right? And there's a few prediction things that we're going to discuss today that's in the phase of before, like fundamentals and technicals. But during, there is a little bit of price action, but it's the only thing we're covered. The rest is all risk management as your trade progresses to balance out your portfolio, to manage your portfolio out. So we're not going to cover that today. Then after, this is a phase that I want to mention because a lot of people skip this, especially when you're starting. You should review every single trade you've done, whether it's a winning trade or a losing trade. When you have a winning trade, it is very good to review why did they win that trade? What made me the decision? So write down before you open a trade what the criteria were that you made that decision to open that trade. Look at what the charts are, what the candles are, everything else. What day of the time, what day of the, what time of the day it was, what day itself it was, etc., etc., etc. Doing all these little elements helps you understand, hey, these trades, you'll start seeing a pattern. It's like, hey, these trades that I do seem to be winning more than the ones that I lose. And the losing trades, reviewing those is very important because it allows you to look at it and go, okay, I lost this trade. No big deal. That happens. It's part of trading. Is there something I overlooked? So you go back to the start of the trade, you look at the chart where it was, and see if there's anything that could have identified or that you may have overlooked that what next time is something like, hey, I need to check this because that last time I didn't know, I overlooked that and it went wrong for me. Right? So revision comes out of these two reviews. You then revise your strategy and you revise your approach, which automatically improves your trading. Right? This is an important stage if you want to grow as a trader. That's the after. Now, exposure, which is part of micromanagement, we'll discuss this a little bit. It's trailing stops and moving stop loss. I'm not going to go into the discussion of trailing stops about and moving stop losses manually and fixed stop losses. This is a completely different topic. There's a reason why I mentioned trailing stop losses, especially for people with smaller accounts and especially for people that don't trade 18 hours a day. Obviously, manually moving your stop loss and micromanagement would be better, but we're going to go into this a little bit more detail later. So the other micromanagement is what we're going to cover later as well, is factoring news announcements or correcting your trades for when they are going to happen. So for example, right, if you set up a trade on, let's say, an hour chart and you plotted it out and the trade is going to averagely, based on the average angle in that trend, is going to take roughly 8 to 9 hours. Well, if that is the case, you factor in if there isn't a news announcement from the economic calendar, if there is any news announcements along the way in those 9 hours. If you still then insist, let's say there is, and then you still go like, but I want to take this entry point because it's at the perfect point, then you need to correct your trade before the announcement hits by, for instance, moving your stop loss, by, for instance, putting in a hedge in case that you expect counter trade that's only going to spike at that moment, right? So let's say NFP, which you know is only going to spike for like half an hour, then do whatever it was doing anyway. So if it's something like that, you can either hedge it, you can secure it, but you want to make sure that you mark yourself these points because a lot of people lose their trades because they're in green 30, 40, 50 pips, maybe 100, and they completely overlook that there is an interest rate decision today. So they go happy about their day, they go to work, happy days, hey, look, you tell your friends, got 100 pips in profit, I'm like $1,000 up. Amazing. I know, it could be $10, it could be, you get the idea. And then you come home and you see minus 30. But why did it hit my stop loss? Well, you completely missed that there was an announcement. It spiked down to your stop loss, then went back up and went to take profit instead. For instance, that is the worst feeling as a trader when that happens. But it is a mistake you could have avoided. You could have set up a trailing stop, for instance, before you left to secure the entry point at X amount of pips. So you could have also manually removed the stop loss to 0 if you had the opportunity. The bad thing to do is what people do is take their phone to work and then do correction of trades on their phone. The only thing you should ever do on a phone, because you don't have a proper screen, you don't have the proper tools, the only thing you should ever do on the phone is close a trade. That's it. Emergency closure of a trade. I wouldn't recommend doing anything else on the phone but that. Okay, having that said, let's actually start looking at some stuff. So price action. So let's discuss about what price action is. We'll then look at a few examples of candlestick formations and a few examples of chart formations. Now keep in mind, there are a lot. We're only going to cover a few of them. They're the generally more common ones, apart from one I put in there as an example in the formations. Right? This to give you an idea of how these work and what they are. But first, to understand what they are, what is price action itself? So price action is a technique that you use to read the current market and what it might do next. Let me elaborate on that. So candlestick formations in particular, right, is a set of 3 or more, well, 2 or more, but generally speaking, it's 3 or more. There is an exception there, of candlesticks in a certain pattern that generally indicates a potential reversal. And in some cases, it actually listens to this very, very, very strongly. Depends on what you're trading. But in the majors, it kind of holds on. Most of the more commonly traded stocks do, right? The main thing price action is that it is a part of the technical analysis spectrum, right? So when you've done your trend lines and you've done your resistances and you've, in case you do supply and demand zones, you put that in there. Now you've identified all the points. That allows you to judge where the optimal entry points is for in favor of where market movement, where market pressure is most. We're going to look at that in the chart later. And then you can see, okay, this is your go time, right? So the real purpose of it is that when you're at your entry point, you always get that question, or at least I always get that question. It's like, but when do you know to open the trade? And you're done waiting. What are you waiting for? Well, price action is one of those potential tools that you can use to confirm that the trade is about to turn. Right? So a certain formation founds, and 9 out of 10 times when that formation finds itself, let's say it's 7 out of 10 times, right? So 70% of the time, if that formation appears at certain intervals, then that is going to turn the market next, and you know it's going to turn. So if you're going up, you know it's going to go down. So if you're setting up a sell because you're in the top of the channel, for instance, and you're in a downtrend, it's a perfect moment to go in already. Now you have confirmation that the second that that last candle closes, confirming the price action, which we'll look at in a minute, that's when you open the trade on the opening of the next candle that comes after that. Right now, swing traders do this before that even happens, but we're not going to discuss that. What we're going to do is basically wait for confirmation when the market's in the right conditions. Now, let's say you have indicators that are also now lining up, and you have triple indicators, let's say, that are all now going through the signal lines. So you have confirmation A, B, C, D, and now you have price action. The more confirmations you have that line up, the higher the probability that the choice you're about to make is the right one. And in the end, all you're looking for is creating consistency. So taking the highest possible probability of trade in your favor will automatically yield you that, combined with risk management, stuff like that. It doesn't matter if you do lose, because the ones that you win way outweigh the ones that you lose. The wins way outweigh the losses. Furthermore, with ratio systems, one win usually covers like 3 or 4 losses. right? Okay, so, but understanding that price action is basically part of the technical spectrum and what I just described, you understand that it is very dependent on technical tools, right? You identifying the trend, you identifying the resistance and support levels, you identifying market pressure, you identifying, well, let's say you have indicators, that the indicators are also at certain pressure levels, because now you get a confirmation of a certain candlestick formation forming or a chart formation forming, and you have other things to also tell you to confirm your initial, let's say, hypothesis that this is the right time to go in. You now have a confirmation if it lines up. But if you only have the candlestick formation, let's say, it's not at the top of the channel yet, and your indicators are all not even halfway yet, then based purely on the price action, you have a yes, but the rest is saying a maybe or a no. Especially when you have an account under 5,000, you should not be taking the maybe what if trades. You want to wait for the right trades and do quality over quantity. Right? You don't have that much room yet. Okay. Now, the beauty of price action is that it's applicable in any and all securities. So it doesn't matter if you're trading majors, minors, exotics, stock, crypto, it does not matter. Because basically the way that these formations form, as you know, markets don't move because you draw a line on a chart. It's because people put money into a market. They either press a buy button or they press a sell button. There's no in between. So the volume between these two determines which way the market goes. So these price candles are kind of like self-fulfilling prophecies, where once they start forming, and especially when they have confirmed close, all the traders that use price action will use that confirmation, if it lines up with other things, to do the trade opening. Meaning that it's a self-fulfilling prophecy, because all of a sudden you get this massive influx in volume in the market going for the opposite direction of wherever it was going, or whatever it was confirming to do as the price action confirms. So the volume goes in there. You should never try to beat the market. You should try to learn what the market is going to do, because how the market moves, where the volume of the money is, right? If I say there's a million going up and a million going down, where's the market going? Absolutely nowhere, right? There's an equal demand and supply, right? Simple. Now you get these people that's like, okay, there's a 1.5 going up and 5 going down, right? So 1.5 million up, 500,000 down, which means the market is going up, right? Very simple. Yeah, but I'm going to beat the market. That's my mindset. I'm going to take a sell because everybody's taking a buy. And because 70% of people lose, I'm going to take the choice that nobody makes. That is the dumbest mindset you can have, because that is not how the market works. Right? You still have 1.5 million going up, 500,000 going down. Now you come in with your, let's say, one standard lot, pure cash, 100,000 going down. Well, you now have 600,000 going down and 1.5 going up. You're still not even anywhere near it. So what's going to happen? The market is still going up. Yeah, throw in 3 million, all of a sudden you stop the market and it starts going down. That's a hell of a lot of money. And you wouldn't be doing Forex trading if you had that. Make sense? Right, so understand this and understand that you can thus apply it in all securities, because all Forex and CFDs and retail trading, it's kind of a self-fulfilling prophecy because of that concept. All right, so let's look at some candlestick formations. Okay, so, sorry, got a question in between, but it's in French, I think. All right, so let's take a look at a doji first. Now, a lot of people mention doji is also the first one they hear of, but they actually confuse it with evening and morning stars. A doji is not actually a price action on itself. It's actually a building block that a lot of the other ones build into. So here, I'll make it a little bigger. Oops. Did I go left or right? Where'd you go? Oh, here. In, there, in, stop. Okay, so this would be a doji. Okay, it's a long stick or even a half stick like here, but where you have no price difference over the period that you're looking at. This happens to be a day, but it doesn't matter if it's 4 hours or an hour, right? So you have a stick and the price has basically went up, the price has went down. It doesn't matter if it went down first and up after. The result is the price is unchanged after whatever that interval was. Which already, if you now understand what I said earlier, means that in that day, there was an equal amount of money going up as there were going down in the end. And that means in the end, the price did not change because there was no difference in supply. Which means that if you're going in a downtrend or in an uptrend and you hit that, that means that a lot of the buyers have started taking out the money in the market because the sellers have now started taking over. But not taking over yet, it's just equalized. Does that make sense? Okay. So this is a doji. You'll find them all over the place. They're everywhere. Not that. We'll talk about that one later. So where you have an equal stick up and down and then you have it flat, like here, this one a little bit. Like this one is a perfect example. It's basically a perfect cross, right? So it's going up, but here you can see on itself, it's not enough because it still went up afterwards. You just have that stalling moment. And in this case, it was pretty obvious why, because if you put a line on it, it's basically the previous high. Right? You have this wick, this high. So people started hitting take profits, stuff like that, and then probably went back in later. Well, it still went up. But on its own, it's not enough. Sorry, let me just, there we go. Okay, so let's take a look at a Harami Cross. Now, Harami Cross is basically a combination of the doji with a candlestick in front of it or behind it, but generally speaking, in front of it. Now, you will find these more often in stock. So let's take stock for a second. Wait, where did that go? Did I do Apple? I think it was Apple. So here is your example of a Harami Cross. I had one marked up, but I'm not sure why that marked. Maybe I checked something else real fast. Okay, so here you have a candle followed by basically a doji. Now, in this case, the wicks are longer than the body. If the wicks are contained within the body of the previous candle, you have a perfect Harami Cross. And you will see that in stock, you get this more often because you have these jumps in price. It is not very common to see these, like this one is perfect. You don't get these quite often in the majors, but you do find them when you have Monday openings, when you have gap openings, for instance. Right? So if you have a gap opening, you do get it. All right. So that's a quick example of Harami Cross. So that's more for the stock people. You'll find it there. So you have either an up or a down candle followed by a candle that is contained within the body of the previous candle as a doji. 1 second. There we go. That's out of my, had something stuck in my throat. That's better. Okay, now that we're back on track, sorry about that. So let's take a look at evening at Morningstar. This is the more common candlestick formation that people usually confuse with a doji. And if we look here, no, here we go. So if we look at a Morningstar, it is 2 downs into an up. Now the up has to be equal to the bottom of the second down versus the one before that. These 3 are a combination that indicate that because basically all this volume going down has now been negated. which is usually also the trigger sign. It's like, okay, look, we're going back the other direction. And you can see it did confirm afterwards that it went up. It didn't keep going. But if you were waiting for a short buy, this was your time. Now, if we look at other ones, I can probably pull a few up, right? So let me zoom out here. Did I mark anything up here? No. So the pin bars, we'll get back to that in a second. Right, but you'll find them here as well, right? So you have up, down, down. That would be an evening star, right? So up, down, down is an evening star. And you can see this was also the cap. So for those that were wondering, like, okay, when do I go in for the sell? Because we went down, up, and I want to go take part of the sell because I expect to go further down. Once this candle closed and then this one opened before it became anything, this was your entry candle, basically. So yes, you are going to be a little bit later than some, but you have a confirmation. Now, if we look at other previous examples of this, you'll see that it's actually quite common. And I'm not going to discuss that one. And let me see, up, down, down. See, this is an example of where you have a fake one, right? So we have down, going up, and it did stop here, but not because of this, right? This is like an unclean signal. There's other things going on here. Like I said, it's part of many other tools that you use to confirm. Because you have a big green candle, and then you do have the confirmation of down, down, right? So like you want for an evening star, except this candle is way too short to confirm overtake of volume. Here we have down, up, up. We went up. It was already going up, but here you can see that this pullback was negated here. So if your question was, when do I go back in after the pullback happens, this was your confirmation to just go in. Down, up, up, but not that clean. And it didn't go that far. It just went to the previous high, then went back down, and then it went with a candle formation we'll talk about later. Right, so it is, as you can see, I'm trying to give you examples as well of here you have up, down, down. So perfect evening star, but it didn't quite turn just yet. However, if you would have set this straight up, I doubt your stop loss would have been here, but it did go down afterwards. It was delayed, but it did go down. So it's an indicator that it might revert soon. And this would be one of those cases that if you would have indicators, the indicators would have probably told you here that they're not quite ready yet. They're not, let's say RSI, they're not quite an oversold yet. There's still a little room, or it's not crossed your signal line yet, or you have a triple moving average, etc., etc., etc. Add some other options here. So it's not enough on its own, because every single tool that exists, without exception, has false positives. This is why you use multiple that need to align. But obviously don't use multiple different ones that have a completely different way of calculating a completely different thing. Good example, if you use RSI, MACD, and stochastic, they're all moving average based calculation systems, but all calculating it slightly different. Therefore, if one is giving us false signal, the other one will not. And they can only line up if everything lines up right. And then you have your confirmation, right? And then you have this to do your actual go moment. Evening star, well, you do have a small evening star here that did confirm like, okay, we might be going, we might be reversing soon, which it quite obviously did. Not clean. Here it says, okay, I might be reversing soon, right? But there is no up, up, down. So this is important to understand. There is no up, up, down. There is only down, down, up, or up, down, down. Right? So let me go back to my example. Where are you? No, that's the pin bars. Here. No, that's a false star. Wait, where, guys? Where? Oh, here. Here we go. So, right. So this is a clean one. This is the way it should be. And you can see that it's clean. Here we say we reverse. Oh, let's follow it. Well, we reversed them down, but not really. We went down a little bit. But then you had another signal here. Okay, so, because we have quite a bit to do. That's an example of evening and morning star, right? So evening star, up candle, small down, bigger down that covers the rest. Morning star, down into a small down, into an up candle that covers both. That's the two options. Now let's look at something called pin bars. Now there's two types of pin bars. You have bearish pin bars and bullish pin bars. Now, let me explain those in a second because they're right here. So when you look at a pin bar, it is a combination of a green and a red that has to be next to each other. Like this. Like one up, one down. Basically creating two hammers. But here's the difference. This is a bullish pin bar because the hammer's on the top. A bearish pin bar is when the hammers would be at the bottom here and the wicks are on the top. That's it. That's the difference. They both indicate a possible reversal coming. Now, in this case, because we're looking at 4 hours, it did do a reversal, not for long, but it went back to this resistance line where it bounced off. So if you're doing small time frame trades and you waited for the confirmation the second this opened, your entry point would have been this one for a buy, obviously, because you were going down. This would indicate sell. Your stop loss, without knowing any of this, would be somewhere over here, a little bit underneath the wicks. I don't know if there's any paths that I can cheat from here. Not really. No, but anyway. So let's say you done your technicals. There's another resistance here. You just put it outside that a little bit. Your take profit would then obviously be here. Now, before you then open the trade in the first 3 seconds that this happens, because you've calculated this the second that it started, you can now look if it's even worth the ratio. So 60 to 100, 1 to 1.5 is not perfect, but it might be something that you want to take anyway with a very small window because you know, right, it's not going to take long because it's a small distance compared to the way it fell, etc., etc., etc. Completely different thing. But basically, this would be a little bit less ideal ratio trade, but potentially a very good trade. So if you have other things that are indicating as well that this is a resistance, for instance, that it bounced off, got rejected, you already had a rejection before that, right? And this little thing next to it, come here, right? You had a doji, you had a big drop, then you get a doji, then you get 2 pin bars, right? And then your next one that you just opened on turned out to be a doji as well. All right, so big drop, so a lot of sell, dead market, dead market, dead market, and then yours is also a dead market, which means that most likely this sell is not going to happen anytime soon first. It's going to, what we say, reset. It's not really a reset. It's just temporarily the sellers pulling out their money, which means that the buyers are going to overtake, so the volume goes back up until they get to an entry point where they want to retake their sell, which is usually at the next resistance point. Ta-da! Right, that's why I said it's a self-fulfilling prophecy. Because now you also have the buyers going like, oh, look, we have pin bars, so we're buying. So you can benefit from that mindset. Okay. So there's just this, and then if you flip them around, that's it. Right, I hope that's clear to everybody because we still got a lot to cover. All right, now engulfing candles, a lot of people hear about these a lot. So an engulfing candle is more easy, is super easy to understand. Is when you have a pattern of in going one direction, so in this case selling, right? And let's say you were in this uptrend, right? So all you have as information is this bit, right? So here it's reset, you go back down, you know that now that this is no longer valid because it broke here. So let me just draw that if I go too fast for people. So let's say this was your trend line. You have this that confirmed that it broke, and we're currently on this candle. Right, so this broke and then it already pulled back, it topped out. So you already know I can delete that. And I can now look at this angle because this is flipped around. So I only have this as a reference point and I have this as a reference point. So I'm just going to pull that on, and I have my bottom point that has to be after the starting point, and I can pull that in there. Right? Some people would say, why didn't you do this? Your bottom cannot start before the top. We're in an uptrend, so this is the starting point. Your bottom can't start before that. All right, so we have an angle, we have a trend. Initial, because we only have this top as information with this one. That's it, that's all we have. And we have this, and you might say, okay, I'll do this, fine. Okay? But in this case, you would either take the wick or this wick. Let's just take the wick because we have limited information, so we want to be a little bit broader. We're on this candle already. So this candle, sorry, we were somewhere over here. Now this candle happens to close here. It opens here. Then the candle that happens next, and this is where the engulfing part comes from, completely eats up this candle and half of the previous candle. So once this closes, you have a confirmation that whatever this was is definitely over now, and you have your go moment. Now this one happens to be a little bit big in comparison to how broad the channel is. So you would have an entry here, your take profit would be at the top of the channel that you would have drawn. Without seeing any of this, your entry, you would have basically done this, right? Like this is my angle, right? Like previous, that should be roughly the angle, so I'm gonna do the same thing. So if I go in here, my angle should be roughly this. So my take profit would be there. Well, that's actually where it wicked. Perfect. Lucky you. Except, the entry point's not great, right? You're in the middle of the channel. You would have to take a risky, okay, this is a day. So at an hour, this would look different, but I'm just using the day for the examples. Like you wouldn't trade on a day, obviously. In most cases, you would execute on either 4 hours or an hour, or in case you do lower, then that's your execution time. Okay, so but here in this case, you could have held, because this we only had A and B as a point as reference. We don't, and it was a really, really big early starting point, so we don't have any reference of if there's actually going to be the channel or if the channel is going to be what it eventually became. That. But you couldn't have known that here. At the third point, you could have known this. 1, 2, 3. You would have had this. It actually exceeded that a little bit, so there was a massive amount of acceleration within this, which was also showing here. But okay, we digress. So engulfing candle, down, down, and the most important thing is the last down and then a big candle up. This is not an engulfing candle. Yes, it eats this previous, but look at the wick that's underneath it. See how there's no wick underneath this? It is engulfing the entire volume levels. This isn't. So this wouldn't be clean, but you have, again, other tools. This one is twice the size, so it covers the wick distance as well. If you drag this down and put the tops equal, this one is still bigger, so it does engulf. This does engulf, right? 1.5 almost. But you just started dropping. So here we have, well, look at here, Morningstar, down, down, up. And it's going up. But this is, okay, so this is oil. Right, so engulfing candle, it can also be the other way around, of course, if you have a green candle up and then a massive candle down, right? So this would be an engulfing candle to this one. This is, I mean, I would say slightly engulfing on that one, just by a insy-wincy little bit. This is a good example. You have nice couple candles up, you got to the previous high, and then you get this opening, bam, which is literally eating this and this candle. It's eating both the previous 2 candles in distance and volume, right? And you were at the top. So the next opening is just your, yes, okay, I should go in for that sell now because this is your confirmation. I'm pretty sure everything else would have lined up by now as well. Like your slow moving average will probably be caught up with this curve. So then you can sell, and then you would have actually made a nice little bit of jump in case your stop loss was based on the previous resistance down here. You would have actually nailed it. Yes, you could have made this little bit extra, but remember, we're not trying to make the best trade in the world. We're trying to create consistency. That's the aim of the game. Okay, so now we looked at a few candlestick formations. Let's look at some more common chart formations. Now, the first one everybody hears and everybody knows, and they learn about it by accident without knowing that it's actually price action. Double tops. I don't think anybody needs an explanation of what a double top is, right? We see it everywhere, double tops and double bottoms. It's equal to each other. So you have a body closing at a certain line, which is usually a resistance or support, but it then moves down, comes back up, and hits the same levels as before on the body. Not wicks, guys. It needs to be bodies. Okay? So if we look here, same thing again. If I put it on the bodies are touching. But if you would have, let's say this was the body, so this one is higher, and then the body is over here. I'll make it a little bit bigger so you know what I'm talking about. Whoa, where'd we go? Oh crap, lost it. Give me 1 second. Oh, where we go? Where did we go? Now, we'll take this example, it's fine. All right, so let's take as an example this body, right? But let's say that these two candles here, let me zoom in. Which way did it shift? It shifted to the left. Okay, so it's always going to shift to the right. Okay, cool. Let's say this body was full, this body was full to the top, and then here you just have to, these two bodies, but these wicks. That is not a double top, because in that case you would have had, come here, this. They're not equal. They need to be straight line across. Now there's a little wiggle room, but not like this example. This is not a double top. Or these two, right? Well, let's say there was a wick on top of this thing all the way over here. That means that these two line out. Yeah, sure, but that just means that there's probably a support or resistance level there. In this case, resistance. That it bounced off. Nothing more, nothing less. Not a double top. Double top. All right, let's go back to the example. Boom, clean. Bodies and bodies. Right, if I make this one move slightly on the green one, it's a perfect range. Like they're fully body topped. That's your double top. And as confirmation, it kind of went down afterwards. It's very intimate with. Now the other one that people learn about is something called head and shoulders. This one's actually harder to identify when it's developing than it sounds. The last one we'll discuss is cup and handle. I just want to find one example of it. It's more of a stock thing. Yeah. You don't find it often in the majors and the minors. Head and shoulders is literally an upside down, or, well, it's either an M or a W, but a little bit different. So to explain that, this would be a head and shoulders. You come from a low point, you go up, it bounces off of a certain level, then goes by it just once, and then stays within this first range that it made. And you get basically a double top like this with like this peak in between. Right, so this would be your W. But it's like a mountain range drawn by a 3-year-old. Look at it that way. Now, what basically is the end of the, that's why this one has a different color. Once this starts developing, so you have this, you have a higher high, which you would indicate, hey, you know, you're still in the uptrend. It then resets down to the previous low that it bounced off. In this case, it had a gap opening all the way down here, and then it closed the gap. Cool. It pulled up, up, down, not a thing. We then had up, we hit it, and then we had another gap opening, a gap, and then it went down, down, down. Now, the second that it now closes, for when you have this confirmation, point A point B and point C. If you have point A and C line up, that is the last top, second shoulder, right? So once you get back to the bottom previous line, the second the candle closes underneath it, that's where your sell starts. Because that's where it confirms it breaks it. Because if it doesn't, it might go back up here and you might actually start having a horizontal movement where you have a consolidation phase where the market is not sure which direction it's going to go. At least the money is stuck in a range. People are buying at X, people are selling at B. And it's constantly the shift of money every time it reaches those 2 points, right? Because people are buying here and take profit there, while sellers have their entry points here and their take profits there. So it just keeps bouncing up and down between these levels until the market gives them a reason to hold. Could be a news announcement. In case of stock, right? Like the Japanese index. Could be news, could be development with name anything big, right? So that's part of the JPN 225, right? That is what would create the reason. What is the fundamental driver? We're not going to discuss this today. Okay. Now, cup and handle, I have an example that for some reason I can't find. Where did it go? Okay, did I accidentally delete the markings? Oh, now I gotta find it. Okay, now bear with me 2 shakes because I gotta refine one. So here, right? So you would say this is like a V. Now let's say you're on this candle right here. Then you only did select horizontal line. Then you only have these 2 information points, this one and that one. And the same from the bottom, you go up, you have the wick, right? Now you have a cup with a handle. This one will close underneath it. So it broke the bottom one first, which means it's going to go down next, according to the price action, which is what it did. Yes, it had a reset up top. Hold on, gap opening, jump, whatever reason that was. It's Apple, it's stock. They can do that. But then it did confirm it. It went down. So price action is not always the moment that it confirms it. There can be a delay. Yes, Nafa, you will get a recording. Okay, so there's it. Besides all these guys, for those that are wondering, the recording will also be uploaded to YouTube. You won't have the Q&A section, but like I said in the intro, it will be there. It will get uploaded to YouTube by Legacy FX eventually, next week or something. Okay. So now that we covered a little bit of the technical aspect, let's look a little bit of a different aspect, and that is the fundamental stuff, right? As Forex traders, we are more leaning towards being technical because that is because of the time frame that we're working in, right? You're not doing a 6-year investment. What I mean by that is you're not doing a structured note where you open the trade now and it's in a benefit, you're the beneficiary and it's in a trust for the next 6 years, and then whatever happens after 6 years, you get your coupons paid out. We're doing small time frame trades. We're doing like an hour, intraday, a week, maybe hold it for 3 weeks if the trend is holding and the trade just keeps developing and you're like, screw it, let just the trailing stop take care of it. I'm taking to take profit out and just let it grow as long as it goes. But even then, right, you're not trading Q1, Q2, Q3, Q4 of the year. You're trading week 1, 2, 3, 4. So our time frame is completely different. So we don't trade on fundamental drivers. We don't trade on that concept. It's good to understand where the markets are going in general because that helps you understand where is going to be the most money from, between quotations, money market makers. Where is the big money going to invest and how are they going to invest the money into the market? Well, news announcements are like short time frame fundamental drivers. but be careful. Fundamental drivers are completely different from news announcements. There is an overlap. For instance, interest rate decision would be one of them. That's a fundamental driver, right? Because it's a direct reflection of an economy and a company, a country's economy. Because that's how the central bank basically calculates their interest rates. But anyway, the first thing to do when we talk about Forex, when we talk about news announcements is, well, first of all, where do we find the news announcements? I think it's not going to come as a surprise to anybody, but who wants to tell me? I woke everybody just up. All right. Who's still awake? Who can tell me? Where can I find the news announcements that are going to happen for the next week? Come on. Don't be shy. Where can I find news announcements? Well, John, there, nailed it. That would be a place to find it. But what would you call it? What do we call it? What we're looking for? Yeah, the central bank website, I guess. Business newspapers. That's kind of like Bloomberg. We'll touch on that in a minute. Yes, thanks, John. So the Forex calendar, or otherwise known as the economic calendar. That's what we're looking for. So there's different places, right? So investing.com is being mentioned, yes. So there's a few other with FX in their name, and obviously Legacy FX themselves have it as well, right? So if you go to tools, yeah. So when you have an account, there's going to be you're going to have the option tools, and in tools there's going to be the economic calendar. Now, if we go here and we go economic calendar, make sure that you set it up for your time zone. So I'm GMT +3, so I just pick any GMT +3, doesn't matter what country. And then we have, oh, I hate all these ads. Anyway, so investing.com is a really good one actually for several reasons. But one of the things you need to understand first, you need to learn, is understanding what the impact levels mean. Now, economic calendars all have a different option, right? You have, okay, you have 1 star, 2 star, and 3 star. There's you have that have 1, 2, and 3 skulls. You have color coding between green, yellow, and red. It depends on what you're looking at. There's always a register or a legacy that tells you what is. Now here's the important thing. You don't necessarily need to know what the news announcement is or what it means. When you start learning fundamental trading, you're going to click on them, read up on them, and then see how they reacted in the past. But what you do need to understand is that there is a potential volatility at time of announcement in the market on the short term. That's what they are. So 3 stars could mean that in the short term, there is going to be an influx in volume. Could. If a certain news announcement is, a touchy thing, I'm not talking about the NFP, an interest rate decision, right? And they said they were going to hike and they end up not hiking. Well, that can be seen as positive, it can be seen as negative. It depends if you have a bearish or bullish market, it depends on how the reaction is in the past. Now, what you can do there is you can look at, let's just grab a random one. So let's this one. Okay, so what you can do to back check is like, okay, how does it react to things? Now, you don't need to go by 5 years, right? Just look at last year and then take a few months. So what you do to test this is you look at the results. So in this case, you have a forecast and the actual came out negative. Before that, there was a forecast and it came out slightly negative. forecast positive, forecast positive, forecast negative, forecast negative. Okay, so what you do is you do on all these dates, right? So here you have the 28.6, here you have 31.5. You do understanding of what the data means. It doesn't matter if you don't quite understand. Now, on investing.com, like I did, I clicked on it and you can read what exactly it means, what it is. Later down the line, if you include fundamental trading as part of your basic strategy, yeah, you should understand for the, especially the major, let's say 15 things that you trade, exactly what news is important to that particular thing that has a touch with the drivers. But what you need to understand from the data is not necessarily what the description is and what it means. It's what it means when it comes out positive and negative. So now you can do back testing. Go to your chart. I don't even know what I clicked on. CB US. Okay, so something with US. Right. So let's say the US, and you simply do this. So this is 28.6. So you go here, you grab a horizontal line, 28.6. 28.6. Oh wait, that was today. Of course it was. We go in. All right. Well, you're not going to look at a day because the day is down. Doesn't tell us much. Go to an hour. Snap it to the end. Come here. Okay, so this is where the day started. Where was the news announcement? Okay, now it's on 28.6 at 7. This news announcement was at, now we go back to the previous, so here. This news announcement was at 5 p.m. my time. It is around 9 p.m. my time. So that was 4 hours ago. So current time, 1, 2, 3, 4. So this little candle is actually the news announcement. Okay, so here it came out worse than it was. Well, it just meant that this wick, because there was a lot of selling pressure, the US dollar lost a little bit of power in that hour somewhere. But then it just caught up and now it's stalemate. So this could be the after effect of that announcement though, right? That the market starts stalling out. Okay, we had more information, right? So let's look at the previous one, 31.5. Again, at the same time, because they always get announced at the same time. So 31.5, somewhere over yonder. This is all, oh yeah, we're an hour. Like, why is it taking so long to get to May? June, May, 31.5 is right here, it's this day. So now we go here, we go to an hour. 31.5, April. So May should be here. So 31st. Right, so this is what you do, right? So you go to 31st and you go to 1700, which is in my case the case. So, right, so, no, did it say 1700 here as well? Sorry, I'm not looking at the time on the bottom. The time on the bottom is the server time of the execution. So 1400 or 1600, right? So we need to go to 1600, right? Okay. That should be June, April. Oh, there you go. May, 1600. 1, 2, 3. Here's the announcement. So it was going down pretty heavily. The announcement came out negative, but close to the forecast. What happened? The market stalled. It basically bounced back up because this candle started at flat here, right? So you have bottom, completely covered the previous one, and then you had a lot of, buying, selling happening where it's dead, but then it continued on for a little bit, and then afterwards, this is an hour view, guys, right? So the announcement hits here. We had a little bit of profit from it for 5 hours, then it started dropping again, and then it eventually did whatever it was going to do anyway, because it was going to follow this, which it didn't break till there. Now this wouldn't be the trend line, obviously, because it doesn't cut through the handles, but you get the idea. All right, so now that you understand first, what the impact level indicates, right? It's a short time frame potential volatility increase, right? The amount of stars or skulls or flags or colors or whatever the indicator is dictates how heavily by historical data, this is how these indicators are made. Historically speaking, on this announcement, there can be a low, medium, or high volatility in the market on average if it hits. Now, some of these need to be reviewed over time. For instance, the NFP, if you look at 2012, pre-2012, the NFP would determine what the US dollar would do for a week. If it came out green, cool, buy the dollar for a week blindly. If it came out red, sell the dollar for a week blindly. Nowadays, it does a little bit up and it does a little bit down and goes back to where it started within the same hour candle and then just chugs on whatever the hell the day was doing that day anyway. The NFP became less important. There are now other factors that are more important. Now, that doesn't mean that when the economy changes that it's not going to switch back where the NFP becomes more important again, but it's not right now. This is the nuance when you get more experience. Well, okay, so where does it shift? When does it shift? But this is why it's important to do some back testing from the recent market to up to a few months ago, like go back 4 or 5 to get a good idea of how does the market react when that news hits in favor or against it. All right, so how do we actually use these news announcements now? Okay, so first of all, let's determine or apply our strategy. So if you are day trading, so let's take an example. Okay, we're in this 1 hour. Let me just go to current market. Boom. Okay, we're selling now without any technical analysis. Just bear with me, guys. Let's say everything that you've measured says like, okay, you bounced off of this level. Let me just make the line a bit thick and black, and so it's actually like, okay, so you bounced off of that level. Cool. There was the previous high there. What is this, an hour? Okay, it's an hour, that's fine. And then there's like a in-betweensy somewhere over here. Okay, cool. Let's say that's your technical analysis initially. You don't have a trend because you just dropped. You want to take a buy. All right, cool. Now, so you determine basically on average angle of that once it goes up, on average it goes up like this, and it bounces back down. Right, it goes down here, and then it goes up to, here. Then it bounces back down, and then from here it went back up there. All right, so these lines on average are, you put them all on top of each other. So this is the median. Right, so lock that in. Come here. I'm doing this really quick and dirty right now, guys, so just bear with me. So this is the median. You want to take the buy. You expect it to, so something like this. All right, so we planned it out. Okay, cool. That's a 60 pips. What do you do? 17-hour trade. 17-hour trade if it follows this average angle of like up, down, up, over, blah, 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 to get to this level, which is based on the previous levels. All right, cool. 20, but basically from where we are right now, boom, it's another 18 hours. Okay, so if you're an intraday trader, right, we are in your within your 24-hour window. All right, let's say you want to do market execution. You go in here, boom. Okay, so you do all your due diligence, blah, 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 blah. Right, so I go in here, boom. And my stop loss would be obviously outside that wick because we don't want to, but it shouldn't, but we just want to be safe. Okay, so this is our distance. And then we have, boom, our take profit equal to previous high. All right, cool. So ratio wise, we're at 30 to 60, perfect, 1 to 2, 1 to 2.3. Cool, I'm good with that. Okay, so you can also wait for it to go back down a little bit and then go in, but blah, blah, blah. Let's say you market execute right now. You now have your trade running. It's in the next 17 hours. Well, what do? Well, you go to this thing and you look forward for the next 18 hours, 17 hours. Tomorrow, I want to know everything about dollar. So you can do here, you can set the filters up if you want, if you just want to know dollars. But okay, so let's say, what am I trading? Oh wait, well, not just dollar, it's euro versus the dollar. There's two pairs in this equation. All right, so I need to check all euro news and all dollar news tomorrow. Right, okay, so nothing, there's a few things. The ECB is doing some random stuff again. Nothing is expecting a lot of bouncing. The US dollar has some low impact stuff. Oh no, wait, it's got a GDP thing that might be good. Speeches are always dangerous because we don't know what they say. They might say something American and then the market freaks out. Okay. So imports, okay. The euro, okay. Lagarde. Okay, there's actually quite a lot of stuff happening in the next, 24 hours. Okay, so what is my strategy? How do I apply this? Well, two things. One, okay, so the first announcement is going to hit in about 6 hours. Okay, that would be just before it hits here. So if this is my entry point, basically I would say the second you get here, when you're already starting to get near this point, you move your stop loss to 0. You secure your entry point before the news announcements start to hit. Because if it does bounce off of this, goes straight back down and goes through your point, it's better to go out at 0 and have lost some time than go out at minus 30, whatever it was, after you've been plus 40. Because that's that moment where you take that laptop and you fold it the wrong way around and then just chuck it out the window. But it was completely unavoidable. Now, I know what most of you are saying. Yeah, but I'm at work. I know. So this is where the debate trailing stop comes from, right? So in this scenario, you would go like, okay, round about there. Okay, I need a 200 pip trailing stop. So let me just, what do we do? Buy. So you set this up and you boom there and you boom here. There. Okay, so trailing stop, what did we say? Yeah, about 200 points. Okay, trailing stop, custom. This is in points, not pips. Make sure you understand that. So put 200, not 20 pips. Okay, take that out. Take this out. So what does this mean? This means that if your trade develops positive for 20 pips, or about 200 points here or over here, automatically this stop loss will now jump here. And then move 200 pips, 20 pips, 200 points, away from the highest point it's been at. So let's say the market is over here, and you count back 200 pips. Well, perfect actually, because the stop loss would be just right underneath here, which means that if it pulls back here, bounces off of that, and then goes to your take profit, great. But then you also have the argument, I'm now risking 200 pips to make another, I'm risking 20 pips to make another 14. If you really start seeing it slowing down, this is where you might intervene and do a premature close because you're risking more than you're willing to make. You do the same ratio. Okay, but this is how you calculate in the next 18 hours on your intraday trade for that news announcement that we had a trade open for. But when do you act? So let's say we're in the same scenario, but there's a news announcement in an hour. That's a perfect example. You can do two things. You double check backwards testing on that pair that you want to trade in. What happens when an announcement reaches? What did it do previous times? How did the market react? Was there a reaction, yes or no? If there was a reaction, how did it react? And then make your judgment. Does that mean that it might give you a better entry point? Does it swing the market, generally speaking? Or does it do nothing? Whatever the answer of that is, you have your answer whether or not you should throw open the trade now. Second option is pending orders. Now, if let's say in this scenario, you know that usually it spikes down in the scenario that we're in, right? So in this scenario, let's say usually the announcement is next hour, and if it comes out as according to prediction or worse, by past history that I just checked, this always goes down in favor of the dollar, basically, right? But then always pulls back in, or 80% of the time it does. Then you can set a pending order to start here with the same stop loss, because that doesn't change, because the market tells you where to put it. You just have a better entry point with the same take profit, but a different lot size because you obviously used variable lot sizes. Next webinar. Right, so this is when you can act. So this is before. Now let's say you have a trade open. Let's take first scenario, you're 10 pips in minus. It's been developing for 3 hours or 3 days, don't care. And it's minus 10. So what do? Announcement's gonna hit in the next hour. You're nowhere, you're still minus 10. Can't move stop loss to 0. My stop loss is minus 35 or 100 pips, I don't know. What can you do? Close the trade, take the loss. Because you did the same due diligence as by the other example. You already back tested, you already checked what happens generally speaking when a news announcement hits. You should have anticipated the trade before you even opened it, but you forgot. It's fine. And then you check the economic calendar and it's like, ah, shit, I got a trade open on euro US dollar. And there's euro and US dollar news the entire day tomorrow. Crap. Or in the next hour, let's say. Well, then you can either take the loss, take the risk of taking a higher loss with the off chance you make some money. Because people will go like, yeah, but every time I close the trade, then afterwards it goes to my take profit. Trust me, if you would actually write them all down in Excel, it's way more often hit your take stop loss instead of your take profit when it does that. It just feels the other way around. But this is a statistics game. You have to approach it like math. Right? The Dutch made a really good decision to make, for instance, in a place called Zeeland, there's this beautiful water system to close off the waterworks. It's completely AI controlled because humans are too fickle to mind, and it has a very strict level. At X, close. If it's even 1 under X, don't close. Right? This is the benefit. You need to think like a robot, or act like a robot, but think like a human. So when you are during, right, you need to micromanage it accordingly. If this is the scenario where you are at work and it's like, ah, crap, I didn't set up a trailing stop, it's at minus 10, this is where you just need to take the loss. Close the bloody trade. Don't risk tripling your loss compared to what you have now. In the off chance it works in your favor because you can't do the back testing right now. Just take the L. You can fix it later. It's easier to fix it when it's small than if you let a couple big ones hit and then try to fix it with half an account. Okay. And the other option is obviously wait for the news announcement to hit, have it develop. When it gets it out of its system and the market starts to stabilize again, open your trade afterwards. Right? It's that simple. And that also covers what we just factoring in before opening the trade, which what we just did, and adjusting it during the trade is what I said. You move the stop loss to 0 if you can, or you have a trailing stop running that should be at a certain criving point. Right? These are your options. Or let's say you're 30 pips in profit, your take profit is at 80, your stop loss is 30. Do you want to risk going back 60 pips to your stop loss and basically lose 30 pips of profit and add 30 pips of loss as injury to insult? Or would you rather just take the 30, screw up your ratio a little bit on your average trades, but then go back to, I'll fix it later? Or best option, move the stop loss to 0 if you can. Worst thing people do, and I see people do this, is they are in negative. The announcement is going to hit soon. They've completely forgot about it. You know what? I know the trade's going to go up afterwards and just they're in the buy. It's going to go up or down afterwards and it's going to hit my take profit then. I'll just remove the stop loss for now.
or make it like 4 times the size it is right now. One, you didn't calculate your damages according to a triple size stop loss because you're using, I hope, trailing variable lot sizes. And even if you didn't, then your strategy would definitely not apply to it, because you, with a linear system, you would not just quadruple your stop loss, because you also quadruple your loss. And all of a sudden it's like, yeah, well, you know, it's not going to hit it. Yeah, how often has that worked out for you? I know some people have done that that are in the chat now, and I don't mean this possibly. I've made that mistake. It's not worth the risk. You do not create consistency by taking the off chance that it's going to work in my favor afterwards. Take the loss. Okay. So now, before we get to the Q&A, let's apply it all. Right? So let's go to let's see where we can. Can't really create anything here, can we? Days, not really anything. I'm trying to find something with a current potential candle formation, but this is a problem when you do it live. You know, the market's not always in your favor. Yeah, okay, that's definitely not it. Okay, so let's just go through a few. That's a no. Oh yeah. All right. So down, up, up. Is that something? Down, up, up. Would that be something? The answer is no, by the way. It's down, down, up to have a morning star. But we did get an engulfing candle before, which is also, it might reverse soon. This doesn't mean it's going to reverse in favor of the candle that's doing the engulfing, in favor of the thing. So that might say, okay, it's going down. So now I'm going to do a quick and dirty technical, right? Boom. We got our bottoms here. So that's something like this. It's a little bit, it's a diverging channel. Okay, cool. Let's just slap some quick resistances in there just for the example. Zoom out a little bit. So I have some reference here. All right, it's too much static. Let's take the static away. 1, 2, 3. Okay, that's fine. Oh crap, I gotta make the lines different again. Make them big. Green. That's fine. All right, so that one, take the second static. 1, 2, no. Here, no. If this wicks, then we're good. It does. Cool. So that's another one, and then we need another one above it, right? So we get the next one, which looks like it's going to be here. 1, 2, 3, 4. With the wicks, 1, 2, 3, 4. Yeah, okay, cool. All right, hey, oh, almost equal distance. It's almost like that's a thing. Because the next one's right here. See, 1, 2, 3. This shifted a little bit, but this is one of those things, right? The market shifts over time. So it's actually right here. All right, so we have underneath current market price, above current market price, we have a little bit of a channel thing going. It's a diverging channel, but a channel nonetheless. Because it could have been, it was this, but it could be that the market has accelerated. Okay, so we have our down, up, up. We have an engulfing candle. Okay, engulfing candle, maybe turning. So we're going to go back up is because we're going down. So the turn would be up. So let's zoom in. Let's actually do some diligence. Right. Okay. So we're trading GBP AUD. If by this angle that I can take, it's from down up, it's this. From here it was, okay, well, this was obviously really awkward, straight up almost. This one didn't do anything yet. Do you have any? So yeah, here you don't have much of a median except for the one in between these two, which would be this. So we'll just bank on on that. So something like this, right? Get rid of that. So on this average right now, it's over, it's under, it's over, but it's the average to take there. We're currently at this market price, or this market price, or sorry, in this line somewhere. So to go to this point would be an average of 5 bars, which is 5 hours. Now we have the engulfing candle already confirmed. I'm not including indicators. Now the problem is here, we have a bottom, but we have a trend line here. So if I want to market execute here at current price, right, this would be my entry. I have option of stop loss number 1, which is just underneath this wick here, but it's inside the channel, which can be risky, especially if we look at a day chart. But we're doing on an hour. Okay, so personally, I would put it here. But the problem that you then have is this, because that's where we're going. You have to factor in a little bit of a bounce. So now you look at ratios. Okay, so this is 40 to 30, and this is a 60. So you have an inverted ratio because you're late, right? You're already 30 pips into this trade. This was your entry point. You would have been at 20 pips. Because then it would have been fine, right? 70 up, 40 down, which is not 1 to 2 or 1 to 3, but okay, it's a small 1 hour time frame. It's hard to get 1 to 4, 1 to 5. All right, so then I definitely would have to take this stop loss and not the second one, which makes it a little bit more risky. Okay, so now you have your calculation. Instead of using 4% of your capital, you use 2% of your capital. Instead of 3, you use 1.5 because it's A, against the trend because the trend is down, in a diverging channel, so there's more pressure on sell, and 2, you're going against the trend, so you it's because of that, and you're starting late, and to take profit, you want to take less of a monetary risk on your capital. It's more of a punt, like might work out, might not. Right, so 1.5, okay, so 35, 50. So let's say you have $1,000 at 1.5%. That's $15. You have a 30 pip stop loss. So it's help me out here, $3, 0.1. So that's 0.5. All right. That took me way too long. 0.05. You would take your buy. Boom. Okay, we did all that diligence. That's all set up. But I forgot to do something, didn't I? What did I forget to do? Okay, trailing stop, we wanted to start there. What did I just forget to do? Who followed me on what I was just doing and what I was explaining before? What did I not do? Because this is what most of you do without realizing it. What did I forget to do? Thank you, Derek. Thank you, Derek. I didn't check the news announcement. I calculated the bloody trade time, 5 hours, and I didn't go to the economic calendar just to double check. Is there anything in the next 5 hours? Oh, okay. Let's do that now then. Okay, the next 5 hours, what time is it right now? 10. Okay, so it's going to be today / early in the morning. Okay, tomorrow morning, nothing impactful. It should be good on that. Today, is there anything at now? Okay, the news announcement is done for today. Okay, ooh, all right. But now we have to factor in tomorrow. Okay, so euro, or the euro actually has 10 a.m. in the morning. Okay. Okay. This could screw a little bit with my short-term time frame. Well, 5 hours is like 3 a.m. and it's like 2 a.m. in the morning, so it's like another 5 hours past that point. Therefore, my trailing stop triggering here and setting the stop loss to 0 because it basically needs to go straight through. I will just set up the trailing stop to go to there. But let's say the announcement was next hour. What should I have done then now? If the announcement was in an hour from now, what should I have done then? Instead of just setting up a trailing stop and giving it a chance to develop now, according to the calculations already made. Come on, guys, give me a suggestion. What would you do? You leave it open and hope for the best? Do you close it? Do you do something else? Lower the stop loss. You mean make it bigger or make it closer to the current candle? Make it bigger. Okay, so you say move this down, right? So make it like do this. Well, instead of just taking 1.5% risk on my based on my capital, I just took 3% risk on my capital, and my ratios are completely screwed because I'm risking as much money as I'm willing to make. You just gonna stick with this answer? I calculate 1.5% of my capital for the lot size, and I just move my stop loss to be twice the size. So now I'm going like, instead of doing my 15 bucks as 1.5%, I'm now taking 3% risk at 30 bucks. Right, so now I'm taking 3% risk on my capital, and I'm willing to make 3% ROI. It's not ideal. So lowering the stop loss is, yeah, exactly. It's not a good idea. Right? So we got our stop loss because that's what we calculated. Your stop loss doesn't get bigger or smaller, guys. It moves to 0 and then moves up into green, never further down than where you started. Once you've opened the trade, you've calculated your lot size, or if you have a fixed lot size, you've calculated your distance of stop loss. That's where it goes. End of discussion. Now you committed to your trade. But one thing you can do is like, okay, we have an announcement in an hour. Let me take 5 minutes to check in the past how it reacts. If it is in my favor, I have a trailing stop. I can now decide, do I close the trade or did I just happen to open at the right time? Technically speaking, and on a fundamental basis, it might actually get a boost and actually instead of 5 hours, it will complete in an hour. Or if it goes against me, just close the buddy trade now and wait for the announcement to hit and get a better entry point for your buy. It doesn't matter if you just opened it. Just go back out at 0 or take 20 cents loss. Who cares? It's like, oh, oops. Okay, I'll check back in an hour. When the announcement hits, I'll see if it gets lower. It might actually spike down to here. And I will be able, and it like stops here and then gets stalling here. Then it's perfect because then it's at the bottom of the expanding channel. Then I can take an entry point here with a stop loss underneath the second point. So my entry point goes here. My stop loss is even more ideal because it's outside trend and outside resistance. And my take profit would now be almost the same. If I change this now and I go from here to here, and move a little bit. Can you move a little bit for me? Thank you. You're good, girl. All right. You go like this. It's the same 10 hours. Now you move your take profit to here. Now you will probably expect it to bounce off of this earlier, which I would agree with. And now look at the ratio. You now have a 24 to 64 ratio. You actually, the news announcement helped you out. Can you stop going up now? The news announcement helped you get a better entry point for the buy you were already going to do. And once the market settled and the sellers are done with their little news announcement trading, it's going to go back to the top of the channel to reset as it's a self-fulfilling prophecy because, you know, we want to fill the bounces. So when it's at the bottom of the channel, people start buying, ergo, this volume for buy is going to go up. We're just a little bit faster at doing it. So we're going in, we have a better ratio, which means that my lot size increases as well, because if my entry point is here and my stop loss is here, which is now 25 pips instead of 35 pips, I actually add another 0.2 to my lot size. So now I'm a 0.07, which means that I'm taking the same 1.5% risk, but because my take profit doubled and my lot size slightly increased, I take way more profit on the other side. So close now. After checking, back checking,
If it goes against you, in general speaking, of the trade that you're taking, close the trade at entry point or whatever it is right now, even if it's $1 in the minus, like $1 in the minus, just get rid of it. Wait for the news announcement, maybe get a better entry point. Or option 2, if it's in your favor, set up a trailing stop at the first possible hourly resistance that's along the way. Or if you're trading 5 minutes, it almost made me spit up. 5-minute resistance, please don't do this. Hourly resistance, do that, and then boom. There are plenty of options and you don't have to be fast. Can you stop going up now? Where is it? Wait, what is this? Oh yeah, that's the other trade we did earlier. There you go, they negate each other. Cool. Right. So it's very simple to see that you have a lot of options and you don't have to do it super fast. The announcement is in an hour. Take 10, 15 minutes to make a well-informed decision. Don't go like, oh, shit, your news announcement now. Okay, I need to make a decision right now. No, you don't. You have an hour before the news announcement hits. Yes, the market will start moving before that announcement hits, but that's still at least 30 minutes from now. You have time to do due diligence and make an informed decision on whether or not to open, close, or adjust your trade. And this is important. Okay? Right, now, for those that are on YouTube, and for those that are leaving us in the webinar right now, thank you all for watching. I hope you enjoyed it. I hope you learned something. And I hope to see you next time on another webinar. Now, for the people that are in the webinar, that might still be leaving now, before you guys leave, please note that after I close the webinar, it generally sends out a survey. This is an anonymous thing you can fill in. It allows you to rate me as presenter and the content. And obviously, please do that because constructive criticism helps me grow. 2, it also allows you to give feedback on what would you like to see, or if you had any technical issues or whatever, to report them so we can take a look at it and see what's going on there, or at least legacy effects. And then they will inform me, and then for content, you know, whatever you guys want to see. If there's a lot of you that, and ladies, and whatever you identify as, don't get me wrong, whatever you see, the legacy effect sees a lot of requests for it. We make that content, or they'll ask me to make that content for you guys, and then there you go. All right, so survey is good for those that are leaving. Now, after I take another sip of water, because I got a dry throat today. Pas de son? Not sure what you mean by that. Yeah, guys, the Q&A, fire away. You guys know, for those that want to know what a question mark system is, there should be a question mark somewhere in your screen. Click on it. It opens up a chat. Correct me if I'm wrong, by the way, guys that already used it. And then you just type in, there was no sound, but you just answered the question. It might be on your side. Did anybody else have sound issues? Oh, you're welcome, by the way, John. Glad you liked it. No. Ah, mais attends, it seems to be something on your sound. No, sound was clear, sound was clear, sound was good. Sound good. Yeah, I'm sorry, Armaton, but it seems that it might be on your side somewhere. Sorry. It seems to be working for everybody else, but mention it in and we'll check the review. Yeah, I had a lot to cover, Patrick. I'm sorry. I was trying to get through all of it as fast as I can. Actually, the fast that I spoke now in the webinar, because this is my presentation speed, then I sometimes go like this fast. That's about half speed of how actually I normally talk. That's my head, by the way, it goes that fast. For those that are asking about the presentation review, yes, there will be a review. I am recording it. It will be without the Q&A. You will get the full recording. However, it will also be uploaded to YouTube. Now, I know that a lot of guys in Legacy FX might be going on holidays and stuff like that. But it should be uploaded somewhere next week, probably, on Legacy FX's YouTube channel. So you go to YouTube, you type in Legacy FX, and you will find the channel. There's also all the other webinars I've done. So for the guys that are new to trading, I've done an entire series on technical analysis, step A, B, C, right? I think it's how to draw resistances and trend lines, how to draw price action a little bit more in detail, how to find them, how to use them, and a bit more in detail than now, because now we combined also fundamentals, but then I had a full hour on just that. Entry and exit points, right? How to identify them, how to find them, why to find them there, how your exit point is translated into that. I did that in a skimp today, right? But for you to understand why that's your entry point and how that fits into smaller time frames, and no matter if you're doing stock or whatever. Risk management is in there somewhere, like extensively. Indicators, we haven't done that one in a while. It might be fun again. But yeah, there's a bunch of it. I don't know if you can get it in your Telegram channel. Guys, any questions? If you're a client of Legacy FX, any questions in relation to Legacy FX's policies, or if it's something that you can get on your account with them, ask them. Let me just send it to everybody. Webinars at legacyfx.com. You probably have, oh, I just sent this to everybody. I just randomly answered a sentence, but the email that I just sent, webinars at legacyfx.com, any email that you send them in partition to your questions about Legacy FX, that's with them. You know, I work with them, I don't work for them. So it's like, I don't want to say something about policies and then give you the wrong information, right? So please send them an email. Pertaining opening accounts, like Ola, you requested, like if you want to open an account, yeah, just send an email to webinars at legacyfx.com or go to the site. I mean, it's pretty self-proclaimed. Aneta, like I said, the presentation you should be mailed to you, or you can request it from your, if you have an account with them, with Legacy FX, ask your, if you have a retention agent, what do you call it? Contact person, retention agent. And otherwise, YouTube, Legacy FX channel. So you go to YouTube, you type in Legacy FX. You will also see the other presentations that I've done. Sorry. John, may I ask, why is Legacy at least lot 0.1? Okay, so this is a policies thing. Why does Legacy FX only have a mini lot as minimal and not micro lots? Okay, first of all, that has to do with the contract what they have with the executing bank that they work with. That's where that comes from. But if you want to know their answer on why that is their policy, please send them an email on webinars at legacyfx.com for them to explain why you cannot trade on micro lots with Legacy FX if that's the case. And for some reason, why is the new questions not moving? I'm sorry. I hope that answers your question, by the way, John. Can somebody type anything in the chatty thing? I think it's not moving. Whoops. No, I didn't want to do that. Go back. Yeah, it's not moving for me. Wait, hold on. Let me close it and reopen it. Ah, there we go. Now it works. Oh, it's stupid. Okay. Okay, let me go back a little bit. Who did I miss? Okay, no. Okay, Carabo, sorry. before you move into understanding fundamental trading, retail FX trading is what we're doing, is probably 60, 70% technical, which includes indicators and stuff like that. The last little bit is fundamental. It's good to include it like I did today, like to understand there might be a news announcement to prevent you from taking unnecessary losses because you completely forgot that there's going to be an announcement soon. But don't focus on that yet. It becomes way more prevalent when you start doing stock and CFDs and stuff like that. The majors and the minors mainly move on short-term frame where we work with technical stuff. Because that is where the retail trading happens and retail traders trade on technical. When you talk about a big investment firm that's doing quarterly year investment, yeah, they do it on drivers, they do it on fundamental. They couldn't care less if the next 3 days are up or down. Like it absolutely doesn't bother them. They just look at, we're at point A today, it should be up 3.6% from current price in 3 months from now. So I'm taking a buy and I'll see where it is in 3 months from now. There is no stop loss. It's a completely different type of investing. There is no, my account balance goes up and down. It's just like buying stock. I buy physical cash. This is what a cash trade is. You buy physical cash and then the cash gets devalued or more valuable based on that exchange rate. And then after 3 months, if the exchange rate is in favor, they cash back out. You have a small exchange, which is a swap and all that. And there's your profit. That's how that works. But we don't have that luxury because we're technically trading CFDs across the board, right? We only trade contract for price difference. We don't actually trade money. You kind of trade an IOU from the bank and the broker. The exact technicalities behind how that system works doesn't matter. Oh, I'm glad you say that, Patrick. Yeah, Victor, if you can get it in your Telegram channel, I don't know, but you will get it in your, you should be able to request it if you have an account with Legacy FX. So ask your, who is it, your agent, your contact person. And otherwise, check YouTube and then type in Legacy FX in the search bar. Go to the Legacy FX channel. And you will find the webinar, this webinar uploaded there soon, maybe next week, and then, or maybe even this week still. And then you will get the also access to all the other ones that we've done. I hope that answers your question. Howard, thank you for your kind words, Howard. Thank you, Anita. John left, thank you. I like this one from Greg. Okay, so he says he's new. I was wondering if you had a previous network where you might talk about software and what kind of computer I am using. I can honestly tell you I could do this on a Pentium 1 laptop. It's not about the strength of your computer. It absolutely doesn't matter. I mean, you have having a good stable internet connection might be beneficial. For software-wise, I hate every single trading bot system that exists because they all eventually blow up, no exceptions. Seriously, find me one that's been running for 10 years steady. You won't find one, doesn't exist. Markets change too much. Even with a learning algorithm, right? And here, let me give you a very simple example why that doesn't work. Imagine the trade is a glacier that has existed for 3,000 years. The trading robot calculates probability of what the glacier is going to do next based on historical data of the last 3,000 years that it has available to itself. Yeah? Now, unexpectedly, tomorrow a meteor hits in the middle of the goddamn glacier and turns the whole thing into a lake. You as a human look at that glacier the next day and go like, well, I guess I have a lake now. You know something fundamentally changed. A robot does not, because it still thinks it's a glacier until the historical data changes the algorithm from, oh shit, it's not a glacier, it's now a lake. That gap between that learning curve means that it's going to trade everything wrong until it learned that, which most cases means they blow up the account. So software, The only software you should be using is a proper trading program. With Legacy FX, with any other broker, but you should be Legacy FX, of course, because it's their webinar. You download, once you have an account with them, the MetaTrader 5 platform. That's this platform. It stores all your lines and stuff like that in different tabs locally on your computer. The trade gets executed and stored, so you don't have to worry about that, but you can always find all your stuff back because it remembers all your lines, it remembers all your drawings, so you don't have to open up the website, because a lot of people trade on the website. I don't know why. They open up the chart and it's like, okay, where were the lines again? Let me start over from bloody scratch. You draw the lines once properly on week, 4 hour, or weekday hour or whatever. 3 time frames, guys, top down. Right. So if you trade on 15 minutes, please don't, but you do day, 1 hour, 15 minutes, for instance. Big picture, smaller picture, smallest picture, execution picture. Then you have your technicals, you have your drawings. The smaller one you have to change from time to time because things change, but the bigger picture you will have as a stable. It's like until that changes, then you know there's a fundamental change of the big picture, and thus my whole approach to this current trade changes, which happens once. These trades usually last 3 weeks. So if you're in a day view, you got 3 weeks of candle bars. In a week, we're talking about a quarter of a year. Right? It has been selling, right, since bloody May 2021. So do you want to take buying opportunities or would you like to take selling opportunities? You tell me. What is the more probable possibility of you coming out on top, by selling or buying this thing? Big picture says we're selling. So if that's where the money is, if that's where the investors are, the big guys, they're setting up on a sell, then don't start buying. You're not going to buy them out. Remember, 200 million and you got like $3.50. You're not changing anything. Not to be condescending, but that's just who we are. We're very, 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 very small fish. Even the bigger accounts of like 500,000 are still like a drop of water in an ocean. Anyway, the only software, MT5, MetaTrader 5. Download that, set up your account on that, go. And I don't know why that keeps moving. Okay. Let me see. I hope that answers your question, by the way, Greg. Yeah, okay. Webinars, Mond? Okay, yeah. How do you make profit? Because Legacy FX has no commission or swap. You mean how the broker makes profit, Victor? I mean, I assume that's the question. How does the broker make profit if there's no commission or swap? Well, yeah, there's spread, obviously. Actually, a broker makes money on 4 different sections. Every broker does. Commission is just a 5th level, but you see that it's a little controversial, so they're starting to get rid of it. But there's still 4 paid models left inside the business plan. I'm not going to explain them all, but there's a finance turn that's between the bank, that's the executor, and the broker taking the turn on who's covering the cost. Then there is the swap and loan that does happen even on small time frames between the bank and the broker again, which is like an interest. And then you have, well, if you lose, well, thank you for your money. Well, that's how it works. Oh, let me clarify that. It's not like you lose so it goes into their bank account. The way that the system is set up, and I'll say this, is that when you execute a trade, an equal and opposite size trade is opened on the executor's side. Basically, it's hedging your position. So they never lose. So whether you're winning or losing, it doesn't matter. Because if they lose and you win, the money they lost goes to you. That's how they cover the cost. But if you lose, they win their trade. Not only do they win their trade and take that money, it's double because they win the actual trade, plus you lose yours, which their trade is executed differently somewhere else. So it's not like a one-to-one, and they get a little bit of extra. And then there's another one I'm not going to go into. But trust me, don't worry about commission and spread. There's plenty of ways for brokers to make money, and the banks are very happy having them. Because, you know, otherwise all that money's sitting in a bank somewhere and they'd rather be spending it. Oh, this is a good question. Ravindra, can you please tell how much accuracy a technical indicator has compared to fundamental? Ooh, it's a good one. Neither of them are accurate, and they're both accurate. Let me explain this. Technical indicators. There is no such thing as a perfect indicator. There is no such thing as a perfect technical drawing. There's no such thing as a perfect trade. It's calculated guessing. But it's not guessing. It's calculated risk based on probability. And you use indicators that you set up. And like I mentioned earlier today, you don't use a singular indicator. You use multiple that do a similar thing differently because they all have false signals. RSI has, MACD has, stochastic has, Bollinger Band has, triple moving averages, quadruple moving averages, 5 tuple moving averages, whatever you want to put on there. No, right? Okay, so everything has false signals. Price action as well, right? Like I said, they could be doing it, but I'm not doing it. Because in the end of the day, that is not what makes the market move. The money in the market is what makes the market move. So unless you have direct access to see the exact amount of money being put in, wire transfer per second, which nobody has, by the way. And no. So you do not know what the market is going to do that. So we get close to calculating based on information that we can say backwards. So multiple indicators that do the same thing. Like I said, RSI, MACD, stochastic, for instance, they all are based on moving averages. The one with volume, the other one with buying levels, and the third one with, I lost which ones I covered. RSI is relative strength towards to each other. Okay, so that creates signal lines. Now, when all three line up, they all have smooth moving average, exponential moving average, weighted moving averages. They're all lining up. Your technicals are lining up. You have a price action to confirm your go time. Now you have a yes. Now, if you then on top of that have fundamental drivers, this is a fundamental driver. The fundamental drivers are selling the euro versus the dollar. In other words, the fundamental drivers of the dollar are better than the ones of the euro. In short, the dollar is gaining strength against the euro. That's all it's doing. So you're actually buying, when you're selling euro, you're buying dollars. That's what you're doing. So you combine all of that information. So in the weekly, we're going down, duh. Like we're going down for the last year and a half. Yeah, but it's so low. It's going to have to go back. Yeah, like it had to go back here, like it had to go back here, like it had to go back there and here and then here. It doesn't have to do diddly squat. As long as there's more volume being sold than there is being bought in comparison of these. So as long as there's more value in the dollar, then it's going to keep declining the value of the euro. It's that simple. So they're both important, Ravinda, but fundamental and especially fundamental drivers are way more accurate when you talk about long-term, Q1, 2, 3, 4, yearly view, big investment terms. Short-term technical is, technically speaking, more accurate because that is more the, well, what we say play money, the dumb money is what the investors call it. right? If you look at the big stock exchange markets, houses, Forex traders are dumb money, which for technically speaking, 78.8% or so is accurate because people are just clicking buttons and throwing money away and they're just going, thank you, because somebody has to pay the bill, right? So fundamental, long-term, technical, short-term. And this is why I say 70-30 is probably Forex. But if you go into, let's say, Goldman Sachs, they don't do trend lines and resistances. They have a few things like supply and demand zones and price points and stuff like that. But it's like 70 to 80% fundamental and 30 to 20% technical. It's a completely different way of investing and trading. I hope that answers that question, Ravindra. On which time, Monday asked, which time frames do I take my entries and exits? On month or day? Well, if you're trading month and day, your execution is always on the lowest time frame you use. So if you use month, your technical analysis would be month, week, day, and your execution would be day. If you do, let's say, an hour, then you would do week, day, 1 hour, or day, 4 hours, 1 hour. I would recommend doing week, day, hour, but that's personal. Because 4 hour and hour is basically the same thing. It's just a bit more condensed. Yeah, I'm just talking about time because this is still within a day. So now you go from 24 candles to 5 candles a week, right? And then 3.6 technically speaking, but 4. I hope that answers your question, Mon. O'Brien asks, if I'm using a phone, how can I calculate my profits and losses right? Okay, so first of all, I hate trading on a phone. But if you are insisting on trading on a phone, no, I really wish you didn't. Like, it's better for you to then, instead of making an account for $500 or $1,000, is buying a laptop for $500 or $1,000 and then save up another 500 and then invest. Like, honest to whatever you believe in. Trading on a phone is such a terrible, terrible thing that people started doing. Like, if it was that good, right, why would everybody in like Wall Street and all the big trading firms have 6 screens in front of them? Because you need the information to make a calculated decision. You can't do that on a little 7-inch fiddly iPhone screen. Right? But if you have to, the system is the same. Let's say I want to execute trade here, current market price. Your stop loss would be, you look at the market. Where's the wick? The lowest wick was here. Was it an exceptional wick? Yes, because it was after a draw, blah, 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 blah. Okay, so somewhere over here, but you have all this lower. But let's say you just take it here. So my entry point would be here. You have to measure this distance somehow. There's got to be a tool in your phone if you're looking at a chart that you can measure this. So that would be 221 points. So in simple, 22 pips. If it is 22 pips and I have a $500 account, I want to risk no more than 2% of my account per trade, so that if I build a portfolio of 10 trades, I am only risking 20% of capital, which means that with equity calculations, you will never, ever, 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 ever get a margin call. Even if all 10 trades go to like all the way to like 1 pip away from stop loss. Like, right, your down draw will never be more than 20, 25, maybe 30. That's where you want to have your down draw max. Right, so you have the 22 pips. Now calculate. Simple. $500 is what I got. All right, 500 euros, 500 pounds. I don't care what you have. Let's say you have a very, very small account of 500. I highly recommend starting with an account of 1,000 to 1,500. But I know a lot of you want to do 500. So 500. Here we go. 1% of 500, $5. Right? Easy math. So if I take 1% is 5, then I have $10 if I take 2% risk per trade. You're not going to have a whole lot of trades because you won't have any margin to open most of them, but okay. So we got a 22 pip stop loss. I can take 10 pips risk. At one mini lot, this is a $22 trade, which means that at 0.05, which is half of one mini lot, I would have $11, which is $1 over my 2%, so it's 2.2%, close enough. You can then decide if you want to go one tooth lower or stay, right? But I would then just take it at 0.05. You will then have your lot size, boom, you have your stop loss, your 22.5, and now you just double check for the take profit, okay? Because you don't care. People look at, oh, how much money can I make? No, how much money can you lose? I've never heard anybody complain about making more money. I hear them complain about losing money all the time, though. Seems to be something people don't like. You give them 30 grand in profit, and it's like, oh, that's cool. Like, you understand what I'm saying? Like, don't focus on making money. Focus on not losing money. Then you automatically start making money because you stop doing risky, stupid trades. And weird ass stop losses, like, just underneath the current active candle. It's like, okay, if somebody farts, it goes there. Like, okay, but I'll just re-enter. Yeah, okay, 10 trades later, you've lost the same as if you would have set it up once here, but you've released the same money, except it would have never gotten there. Right? I hope that answers your question, by the way. All right. Ravinda says, is it better to execute the trade in a lower time frame? Yes. By rule of thumb, you need to find 3 time frames for yourself. So if you're somebody that trades on 5 minutes, again, you don't. But if you are, okay, do an hour, do your analysis on 4 hours, 30 minutes, and 5 minutes. If you are somebody that executes on 30 minutes, do, for instance, day 4 hour and 30 minutes. Or weekday, or a week 4 hours, 30 minutes. Something like that. Get a good overview how in different time frames. Because if you have a downtrend in day, a downtrend in hour, and then you're at the top of a channel in the 30-minute, that means that it's based on the historical data from what it's been doing, should start turning now and start going selling. You are a sell in big, sell in the middle, and sell in the small. Your probability of it actually being a full trade is very high because all the market pressure is there. When you're going against it, so if you have a sell here, a buy here, but a sell here again, the biggest picture wins, right? There's more pressure in the big money overview for sell than there is for buy. So you take the sell. But if there is a buy here, this is telling you buy and this is telling you sell, you're an idiot for taking the sell. Of course you lose. You have 2 bigger pictures with more cash value telling you that the market is moving upwards. So if you have a small account, especially, don't take trades against that direction. Wait for the market to get to that point. And even if you say like, yeah, but if it's going to go to that point, why not just trade to that point? Because it is too risky, it can turn at any given point. But if it gets to the bottom where it should be turning, normally speaking, based on all the probabilities on the bigger pictures as well, and then move in favor of what the bigger pictures are doing, the probability of the trade working out for you is significantly higher, with a significant increase that the trade will complete a full run instead of going halfway to a channel and then just go like, screw it, I'm going back now. I'm saying like the trade's alive. It's not, like I said, it's just people closing and opening trades, but you get the idea. We all feel that it feels that way. All right. So I hope that answers your question, Ravindra. Thank you. Oh, you're welcome, Victor. Wait, what? What? Wait, what? I won an award? Where? When? What? Cool. Thank you, but I don't. Nobody's informed me of that one. Maybe you confused me with somebody else. I'm not sure. But thank you anyway for the kind words. Oh, Victor, with a question. Is it possible to do just analysis only by looking at candlesticks in different time frames? No. Like I said before, the candlesticks, it doesn't matter if you do it in different time frames, it's still one thing. One technical aspect of a set of tools. So you always want to do multiple tools that arrive to similar process confirmations, but they do it in a different way, so that when you have in different ways lining up to a singular answer, the probability, basically what you're doing is calculating the probability of your success of that trade happening increases, instead of you just having one information instead of 10 confirmations. Right? Let me give you an example. Let's say you only take one example, you only do price action. You're gonna trade the false signals or the fake signals, and you're gonna lose those. I'm going to get 10 confirmations. The amount of times I'm gonna have a losing trade because I only wait for those trades to line up, which means I do way less volume than you, yes. But whatever trade I do, there's a 90% probability that I'm gonna win it at full extent. So technically speaking, I'm taking less risk than you, I'm trading less than you, and I'm making more money. Because quality over quantity, baby. Worst thing that I hate, social trading platforms. Oh my God, look at these trading accounts. 3,000% ROI, 600 trades a month. Bunch of baloney. Honestly, are you really going to open 600 trades in a month? One of the good traders that I know does 4 trades per year, makes $500,000. 4 trades a year, sometimes 5 if he's feeling frisky. He literally waits for the market to get to absolute perfect prime condition where basically 50 different things line up for the same answer, and then takes the trade and just goes all in. Not exactly all in. Again, calculate a portion. Still worse with a stop loss, but then when it runs, he literally just lets it run for half a year. And then just closes it whenever that time's up. Yes, that's with a massive account, but he did that from the start when he had like $10,000 account or something. Yeah, so call Rupert at some point. Anyway, but yeah, so quality over quantity, guys. Right? Don't try to get yourself to force yourself to get 100 trades a month. It's better to wait for 5 good trades, and win your 5 good trades, than make 50 trades, screw up 30 of them, and then the 20 that you do win with are like half-assed ratios because you actually kind of closed them early, or they hit trailing stops, or let's say 6 of them actually hit full take profit. No, those 6 that you've made full take profit are negated by the 30 you screwed up. So, you might have 5 actual trades at the end that actually made profit, which are all like half-assed. So you make maybe what, 10% ROI? That being extremely generous. It's probably like 3. So you're basically keeping up with inflation if you keep that doing that. Which is nothing wrong with that, but if you're trading for investing, you want to beat inflation at the very least. I mean, that makes sense to me. All right. Go buy a laptop. Good plan, all right. Doesn't have to be a good laptop. Like I said, as long as the damn thing turns on and it can connect to the internet, that's all you need, buddy. You don't need a fancy supercomputer. So what kind of analysis does a scalper use? I hate talking about scalpers because there's a distinct difference between what scalping really is and what retail traders think it is. The true scalping what really is scalping and why it's been banned so much with a lot of execution platforms. Wall Street is struggling with scalpers because this is what they are. They're supercomputers that do 7,000 trades per second. You heard that right. 7,000 trades per second. They buy a building across the street from Wall Street from the execution, so they have a direct line into the market, which is allowed because all the executors do that around the stock market. And you need to understand that true scalping is basically opening and closing trades for like half of a pip. Open, close, open, close, open, close, 7,000 times a second. You literally take micro pips at that point. And that accumulates to a 99.8% win rate for these supercomputers because of the way that the execution works. And then it works. But if you use scalping in the Forex, the concept is you just grab a little bit of a candle. Here's the problem with it. If you don't hit a 90% win rate doing scalping because you don't use a stop loss, you literally go in and you go out at 1 or 2 pips. That's your take profit, right? 1 or 2 pips. So you trade in a minute or 5 minutes. And basically here, okay, sell now. You hold it, 2, 3 pips, close it. You wait for the candle to close, you do the same thing again. Hold it, close it. But if it goes against you, right? So you make like a 2 pip profit, right? So that would be this. So even on 1 minute here, this candle would be your entire take profit. You would have to nail it perfectly. All right, so now you have this price action, right? Down, up, up. Okay, okay. Well, that doesn't exist, right? We need down, up, up. Oh, wait, we have up, up, down. No, that's not one either. We have double bottom. No, we don't have a double bottom. Okay, you can't do technicals because this changes its minds every 5 minutes. Like the time frame is so short, there is no direction in small time frames. I mean, there is, but there isn't. Like, unless you are like lightning fast, right? So now you take a buy. Okay, we're buying. We need to get to 2 pips profit, but let's say because of this size, we're gonna need to get a 1. We need to get here. You do that in volume, right? So you need to do that 10, 15 times an hour. So every 6 minutes, you should have a trade completed. You lose 1 trade because you hold it if it goes negative. You don't immediately close it because you need a 90% win rate. So you hold it when it goes negative until you hit tenfold your take profit, which is minus 20. You take 2, you lose 20. So if you do anything less than 90% win rate, you're losing. It's a terrible trading strategy unless unless you have like something to execute the trades for you that can do the calculations lightning fast, that can, even if you do it yourself, right? It is so much intense work for so little with so much risk. Because imagine, you're not setting up a take profit, you're manually closing at 20 pip loss, you're monitoring it manually per second. You set it up and a news announcement hit and you have a spike. When you have a spike in a minute or 5 minutes, you get a gap. So let's say you were here, you were buying here, right? And let's say it did this entire drop. Hold on, I need to get my question chat out. You get this entire drop in less than a second, right? So this is actually your loss, right? 12. In less than a second. You didn't manually close it, and 10 pips on a news announcement would be nothing, right? So let's actually see if we can find a news announcement in this minute garbage. I don't think so. Because you'll recognize it, trust me. Well, there you go. Ah, happy buy day, bomb. Well, there goes an entire day of trading down the drain. Let's try it again tomorrow. Just don't. A lot of brokers also don't want it because the execution doesn't allow them, because of the way that the transfer works between the bank and the execution, you can't take less than an X amount of pips as a profit. So you can't actually technically scalp unless your scalping strategy now is a 10 pip profit with a 20 pip stop loss. Again, it still doesn't make any sense. You're now just doing bad short-term trades. You're not scalping, you're just screwing yourself over. It's not sustainable in the long run. Unless you have a NASA equivalent supercomputer doing 7,000 trades a second for you with direct connection to without a broker in between, with direct connection to the stock market, and you trade micro pips on price changes and fluctuations. But you're not. So that's a very long-winded way to say, Victor, analysis for scalpers doesn't exist. It's really just like press. It's going up, so I press up. You can do some technicals, obviously, here once you have a little bit of an establishment, but not really. I hope that answers your question, Victor. Okay, so how and when do you use a trailing stop? Okay, so this is a thing I didn't want to really get into, but I can say it like this. I highly recommend for everybody that has a job that when you do your analysis in the morning and you have that entry point and you set up your trade, calculate the average daily range, set up a trailing stop accordingly if it's long term, or calculate it on the hourly, and then look what the nearest resistance is, take that. Now let's say the average rate is, I don't know, 200 pips is the pullback on average when it's going up, right? So 200 points, so 20 pips. Then make it the 25 pip trailing stop, and it should only hit it when it goes outside of that average range. That's it, every single trade. Because that way you can at least go to work or be in a bus or sit in the metro or be out drinking without having to worry. It's like, oh shit, I need to check my phone. I don't know what my trade is doing. Is it ideal? No. Manually doing all these adjustments would obviously be better because you can judge, you have the information, you make like these small extra adjustments. But it's not realistic for people that have jobs, like have a life. I did trading as an income for 2 years. I grew 20 years older in that time because of stress, because I didn't know if I could pay the bills at the end of the month, because you're reliant on the market moving. And if the market's not moving, well, you know, you're screwed. Trading is not a means of an income. It's a means of investment to grow your existing money while you're making money on the side. It's your money on the side that you're making for as an investment while you're making your main primary income. Don't make the mistake of thinking like, I'm going to set up a 10 grand account. Like, yeah, I don't want to go into that, but just think about it this. What is your living expense now? And factor in that that is 10% return on investment that you need to cover every month. What is your account size going to be? Like if you say, well, I only need $1,000 a month to cover all my expenses. Good. That's a $10,000 account, but you need to make 10% return on investment every month. Minimal to be able to withdraw that money and pay your bills. It's not a, oh, I'm going to make 5 grand a month. No, it doesn't work like that. Remember, long term. Don't think short term. That's what blows people's accounts up. Victor, exactly what I was doing. Oh, you were doing exactly what I was describing just now, Victor. Like 2-3 pips profit and then a 20 pip stop loss and manually stopping it there, stuff like that. Yeah. How? Okay, just be. Has that worked for you? Because that's a, the system exists for a reason, right? For some people, it works. Has it worked for you? Without telling any details, or just yes or no? Or maybe you beat the odds, you know. 90% of scalpers lose their money, so if you're in the 10%, 1 in 10, maybe. So you don't have to say, by the way, but there are many other trading techniques out there, and a lot of them are invented Forex things like intraday trading. Day trading used to be a thing pre-2012, pre-2008. There is so much more volume in the market that there is so little volatility and relativity to what it was 2008, 2009-ish. Like day trading was booming then because your US dollar would do 200 pips a day. Now it does 60, right? GBP JPY used to have 600 pip 4-hour candles. Now it does like 100. There is more volume. The market's still moving, but there's so much more volume. So it moves slower. So obviously you can still trade within a 24-hour window as an intraday trader, but more volume means you need to understand it slower, so you should trade longer term. Or your trade, because it develops slower, is going to take longer to develop fully. It's no longer a 2-hour trade. It's now a 10-hour trade. Yeah, but that's what I mean, Victor. It is frustrating because you have to do a metric ton of work really fast in order to get a few pips of profit. When you screw up, it's going to cost you all the process you've been making for the last, I don't know, 6 hours or 2 or 3 days, especially if you get caught off guard by a massive spike that just completely screws you over. And you're not getting anywhere. I've yet to meet one single retail scalper that hasn't blown up his account down the line. And I knew one that was doing it for 4 years successfully. But he overlooked one news announcement, and it was a big one. It was the election of the president. I don't know how you overlooked that one. It was with the Trump thing. And he basically had like 8 trades open and just blew up the account. Because he was traveling. I don't know why you would open a trade just before going, but accumulation of mistakes costed basically him everything. I'd never get cocky, never get settled, guys. I have sticky notes on my wall. It's like a flow chart. Do this, do that, do this, do that. Every time I open a trade, check mark, check mark, check mark. Like you wouldn't want your pilot in the plane to go like, man, screw the checkbox. I mean, I've done this so many times. Just go. Nah, you want them to check everything. You know, flaps up, man, landing gears are working. The brakes off. Is there fuel in the damn thing? You know, did the maintenance guy take all the tape off the nozzle so all the meters are actually running right instead of it just not measuring anything? You know, important little thing. So it's the same with trading. Check everything before you execute. People think you have to execute right now. Well, that's the stress that, you know, with scalping, like Victor said, that what you have. You don't have time to make decisions. So you don't make educated decisions. You're technically just guessing at that point. But when you go to a smaller time frame, you get rest, you get peace. An hour candle takes an hour to develop, which means you can take more than 10 minutes to just sit down, double check, triple check. Yeah, I will take this trade. Calculate the stop loss, calculate the take profit, calculate the ratio, calculate your lot size, measure the pullbacks on average and a pull up and a pull down or whatever to calculate the trailing stop. Like here, market execution, okay, trailing stop. If the average is higher than this, I take this. If the average is lower than this, I take the average. Right, so if this is this, then okay, I want halfway there. I want the stop loss to start moving to 0 because then it starts pushing against this. It needs to break it. Right, so yeah, a bunch of stuff. We can keep going on for hours, but anyway. Right, because people are starting to fall off as well. Does anybody have any other further questions? Like actually pertaining to trading? No? Okay. Right. All right, well then, I am going to say once more,
thank you everybody for coming tonight. We went a little late, but you know what? It's fine. Again, thank you from me for coming, for bearing with me. I hope you learned something. I hope you can apply it to your trading. Hopefully, make your account grow. One small reminder, the survey that usually gets sent out after I close the webinar, take your time, but I would love for you to fill it out. Help the feedback, help me, improve myself as a presenter, the content that I make, and feel free to suggest or ask any questions in the aforementioned open question things. Right. So, with that said, guys, have a great evening, day, or morning, wherever you may be. And for now, thank you. And as always, trade smart, trade safe, and see you on the next webinar.